Hey, what's up guys, it's Jonathan here, back with another public stock portfolio. So as usual, we'll do a quick recap of some of the moves that we made in the portfolio this week. Then we'll do a recap of how all the positions in the portfolio are currently doing. We'll follow that up by talking about some inflation indicators. So with all that said, let's get right into the video. So this week we made our usual move by depositing $10 into the account. But this week we didn't make any buy or sell moves. But with the way the market has moved in the positive direction over the past couple of weeks, I'm not really interested in buying anything in this market, nor do I really care to start any new positions. And currently our account is about 85% in the market, so I'm pretty happy where we are right now. In this kind of market, I personally do like to keep some cash on the sidelines because I think that there'll be opportunities to buy in the near future. Especially that we still have a lot of different catalysts, from war to inflation to possible shortages. We have gas prices. We still have consumer buying power, which is in limbo right now, especially with the possibility of rate hikes in the future. So there's so much uncertainty still in the market that I'm not really buying the Kool-Aid with this current run that we see in the market. I'm more than happy to have it happen, especially given that most of the portfolio is in the market. So now let's go to the iPad. I'll give you a quick recap of how the portfolio is doing. So currently the portfolio sits at $285.86. And all time, we're down about 5.5%, even with this current run we've seen in the market. And for the week, we're up over 2.5%. So it's been a pretty good week. The month has been pretty good too. We're up 10.5%. Currently, we have about $53 in cash sitting on the sidelines ready to go, which makes up, I think that's like around 15% of the portfolio. So 85% in, 15% cash. I think that's a pretty good position to be in right now. The first position that we have is Tesla. Our Tesla position is currently up almost 30%. Tesla has gone on a pretty significant run recently. I believe it's somewhere near almost at 1100 now. So Tesla is doing really good. It makes up about a quarter of our portfolio. Next position we have here is Enphase. Enphase has been doing very well, especially with the high energy prices, and more particularly the high fuel prices that we've seen recently. That's probably some of the reason why we are starting to see $200 Enphase. At this point, I probably am not really interested in adding to Enphase, but I'm more than happy to hold on to what I have currently. Currently, Enphase makes up a little under 70% of the portfolio, and it's up about 27%. Next position we have here is NVIDIA. NVIDIA position is currently up almost 12%, and makes up about 12% of the portfolio, ironically. With NVIDIA, I don't think it's a terrible time to buy if you have a very long investment horizon. I just wouldn't buy right now. I think that we may get a chance to buy it for cheaper in the future, but that's just kind of my opinion on it. But overall, NVIDIA is a good company, so I'm not really afraid of there being a possibility that you might be buying it for too high. The next position we have here is Alphabet. Our Alphabet position is currently down 2.5%. It makes up about 6.5% of the portfolio. With Alphabet at 2,800, I think that that's a little pricey in my opinion. I would probably wait for it to come down a little bit before I would enter into something like that. You also have to realize Google isn't like a high growth company, so your upside is very limited with Google. So because of that, I personally wouldn't buy it unless if I was getting a good discount on it. Next position we have is Etsy. Our Etsy position is currently down almost 31% and makes up about 6% of the portfolio. Like I said, there is questions about how strong the consumer will be in the near future, especially as we start to see the Federal Reserve start to put downwards pressure on demand by increasing interest rates. So this Etsy is something I am looking into buying more of at some point. I'm not really interested in it just yet. I think that an Etsy maybe in like the 110 range starts to get a little interesting to me. But I think right now it's like at 130. Yeah, 127. Yeah, I think right now I'm kind of holding off on Etsy. I already have a pretty good amount of it, so I'm not too crazy to jump in. Next position we have here is Trade Desk. Our Trade Desk position is currently up 7% and makes up about 4.5% of the portfolio. It's pretty high in my opinion at that price. I like it probably sub like 60, sub 65. So this is currently, again, something that I am watching out for if we do start to see it nosedive a little bit. Next position we have here is Amazon. Our Amazon position is currently down 2.25% and makes up about 3% of the portfolio. Like what I said with Etsy, is kind of applies to Amazon as well. Amazon is a little bit more of staple goods, so they do have a little bit more stable of a revenue stream, and they do have not as elastic demand as an Etsy would have. Where in Etsy it's a little bit more consumer discretionary, whereas Amazon's a little bit more consumer staple, at least when it comes to the retail side of their business, which is like only one part of like the million different things that Amazon does. So, but then again, like what I said about Google and pretty much every company in this portfolio is that in 5 years, most of these companies are probably going to be a pretty good bet. So I wouldn't worry about it too much. Next position we have here is Cloudflare. It's currently up like a little bit more than 0.5%. It makes up about 2.5% of the portfolio. With Cloudflare, I have had some consideration about selling this. I don't really want to spend time in this video talking about it, but if you do go to our Discord, in the links in the description, I actually gave a detailed reason why I am thinking about selling Cloudflare at this point. But if you want to know more about that, check out the Discord explanation. I left a giant paragraph there talking about it in more detail. Next position we have here is Disney. Our Disney position is currently down 2%. It makes up 2% of the portfolio. With Disney, I think at 140, it's a pretty fair price to pay for Disney. I think it will struggle again with that consumer demand issue and us starting to see the cost of money go up as well. So this will be something to watch out for. But then again, you know, Disney is like a company that in my opinion, I think is a really good buy and hold for the long term. Next position we have is Matterport. Our Matterport position is down 48% and it makes up 1.5% of the portfolio. You know, with a company like Matterport, I'm really not surprised that it's down this much. Pretty much anything SPAC has really gone beaten, especially after the SEC came out and said that they are going to start investigating SPACs for some of their very, I guess you could say, lofty projections. In my opinion, I think that a lot of those lofty projections are kind of BS. And I personally don't pay attention to them, but we do see that with SPACs, and SPACs are kind of uncharted waters, so the regulation on them is very loose, and that might be contributing to some of the pain that we are seeing with Matterport. And also given the fact they also aren't profitable as well. So it is down 50%, but luckily it only makes up 1.5% of the portfolio, so it has a very small impact to the portfolio overall. Next position we have here is Palantir. Our Palantir position is currently down 40%. Palantir wasn't a SPAC, but it is a software company, you know, high valuation. When the Federal Reserve starts to become less accommodative, high PE names start to suffer, and Palantir is in that boat, so that's why we are seeing some suffering with Palantir. I think that Palantir may turn around very quickly because, in my opinion, I personally put Palantir and Cloudflare in the same boat. They are software and they're both more on the defensive side of cybersecurity, so I'm a little surprised that Palantir is still doing so bad. But it is something I have my eye out on. So inflation indicators. So this week we got the Q1 GDP report. We're expecting a 7% year-over-year growth on GDP, and we got a 6.9% read-in, which pretty much was a nothing burger. Like the market didn't really care at all, which makes sense because it's not like we saw GDP like at 14%, and that's just a clear sign that we're going to have more inflation to come. We kind of saw it where we expected to see it. When it comes to job report, the month-over-month wage growth was up 0.04%, which was about the same increase that we saw last month. And given that the last CPI print we got was at 0.8%, it just shows us further that we aren't seeing a wage price spiral start to take place. And J-Pal might actually be right. This inflation may actually be transitory. And this news really starts to cement the idea a little bit more. But this is something that we should watch out for, especially in the coming next couple of months, as we expect that inflation itself, that reading will actually get worse. So that's basically all I got for you guys today. Thank you so much for watching. If this video provided you value, please consider hitting the like and subscribe button. They both greatly help out the channel, help push this video out to as many people as possible. Also, let me know what you guys think about the market in the comment section down below. I would love to hear you guys' thoughts. And check me out on all my social medias. I've been trying to post a lot of shorts on Instagram and TikTok. So if you're interested, check me out there. And normally I post those shorts on TikTok and Instagram before I post them on YouTube. Check me out on my other socials. And thank you so much for watching. I'll see you in the next video.